Hello, it's David Goldberg, United Trust Bank. For anyone thinking about buying a house or refinancing a home, the big thing that lenders look at besides credit score and credit history is, of course, your income and your debts. And the ratio that we look at to determine how much you qualify for is called your debt to income ratio, or DTI. This number has a limit depending on the loan program, and every loan program has different tolerances. And if you exceed that tolerance, then you won't qualify for that loan program. And things that can affect your loan approval are rising interest rates like we're seeing today, rising home prices like we're seeing today, and of course things that you do on your own like adding more debt or increasing your debt load while you're going through the process or right before. So the big things you want to do prior to applying for a loan is to try and get your debt to income ratio down as low as possible. And that's not always as easy as it sounds. I understand that. But if you have credit card balances that you can pay off, start with the smallest balances first and try and knock those down, because that's going to get your payments lower. If you have a car loan, not a lease, if you have a loan and let's say you only have, 18 months left until you pay the car off, if you can get that loan balance paid down to 10 months before we pull the credit report, we can omit that car payment from your debt to income ratio. So that's a great trick to get your DTI lower right before applying for a mortgage. Other things we can look at when you're in process on a loan are getting a lower insurance premium. Perhaps you have a high deductible or you need to go with a high deductible plan to lower the premium, and that might help allow your DTI to get within the limits. Typically on a conventional loan, your maximum debt to income ratio, which would include all of the debts on your credit report, any child support, alimony, tax liens that you have to pay, and of course the new housing payment, including principal, interest, taxes, insurance, HOA fees if there are any. So conventional, the limit is typically 43%, although if Fannie Mae or Freddie Mac approve the loan in their automated underwriting system, we can go up near to 49%. FHA loans on the other side are much more lenient, and they allow up to a 55% debt to income ratio. VA loans technically don't have a debt to income ratio limit. So as long as we get an automated approval, the loan works, and it's much more lenient than any of the other programs. So I've seen loans with 60% debt to income ratios get approved on VA. Jumbo loans are typically more restrictive. Most of our jumbo programs require a 45% maximum. And then there's some that even require less than that, like 43 or even 40, depending on the program, loan amount, things like that. But hopefully this is helpful information for you if you're thinking about buying a house in the near term. You definitely want to get your debt ratio down as low as possible. If you have any questions, don't hesitate reaching out. I'm here to help. Thanks.